Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here live from Davos. Now, we have some fantastic interviews from Davos this hour. In a moment, we'll be speaking to David Rubenstein, the co-founder of the Carlyle Group. A little bit later on, we'll also be joined by the Chief Executive Officer of Germany's Merck, Belen Garijo. But now we're getting some breaking news out of Norges. This is the Norwegian Central Bank. Of course, this is extremely important because it gives us an indication of what the markets are expecting. Now, pretty much as expected, actually, that interest rate 2.75, the estimate was 2.75. So for a roundup of that impact, that market interest rate decision on the markets and beyond, let's get straight to our Danny Berger in London. Hi, Danny.
Hi, Francine. It is this mix of trying to digest what central banks will do from here on out and what the economy is doing. We are still in quite the risk-off mood considering yesterday's data in the U.S., both those retails and producer sales. So that means European equities, those are lower by 0.8%. And we still have bond buying in full force. U.S. 10-year yields now for the second day, there is a rally there, which means yields have fallen by a cumulative 22 basis points. And demand concerns, that means oil is on the back foot this morning, down 1.33%. And finally, we are seeing a pop in the euro. It had started the day lower, but Knot, of course, the ECB member, was speaking about an hour and a half ago, saying that he sees multiple point hikes. Of course, there had been that Bloomberg scoop that some members were considering just 0.25% moves for the ECB. So some readjustment going on this morning, Francine.
Danny, thank you so much. We're also getting some breaking news out of CNOOC. Now, this is the oil giant, of course, of China. It's not surprising given what we've seen in terms of the last 12 months because of the war in Russia, or the Russian war in Ukraine, the impact of the price of oil. And on the back of that, CNOOC is expecting a 2022 net income to increase about 99 to 104%. This is year on year, and of course it's just to do with the increasing huge demand for some of the fossil fuels that we were trying to phase out, now really back at the forefront, the strongest story for 2022. Now, UniCredit's chief executive says he's expecting Europe to avoid a recession this year, but he's also warning that several risks could still derail the outlook. Well, I spoke to Andrea Orcel a short time ago.
I think there is a danger because we look at the last time there was inflation, and many were still at school at the time.
No one can remember it.
No one can remember, and the economy, the interrelation on the economy, what is generating the inflation is very, very different. And as I said, we are, well, take Europe, we're going from -50 to potentially 3 in the space of a year and something. So how do you assess the real impact on balance sheets and on payments of families and corporates? Is different also because if they have medium-term loans, they haven't rolled their loans yet. And as they roll, you will see more of the effects. So that's quite complicated to see what the impact is.
So for example, what does that mean for NPLs in Italy, and how do you address?
Look, I think we are all in a situation where we see the problem, we see the uncertainty, we all anticipate a potential shock. But if we look at our indicators, they're all very good. I mean, the stock of NPLs is going down still, and the cost of risk is still compressing. And we had a slower October, November, but from December, the pace, both in the corporate sector and at family level, has increased.
So you don't see that accelerating actually this year? Again, you don't see a kind of delayed impact of some kind of shock?
It depends very much on where we're going to land in terms of rates, inflation, and GDP. At the moment, UniCredit felt that we were going to have a shallow recession this year. At the moment, we would tell you that we are going to have potentially a 0 to slightly positive economic growth in Europe. Now, there is a lot of risk. The geopolitics, the war, the value chains, how much the interest rate increase is going to hit the economy. All of that are risks. No. But if we look at the indicator today, we're not going to a recession. We're going to stay on a flat. And even inflation, our view is that we're going to have an average of probably 6% for the year, but the exit rate is going to be closer to 3%. So if that happens that way, then that is quite good news. If it doesn't, we need to be prepared for a shock, but we don't know.
So that means what? Extra provisioning? Extra cleanups?
Well, we have taken the view of managing for what we see, i.e. relatively optimistic, but taking big buffers in case we're wrong. So we've created overlays over normal provision. At 9 months, we were already 1.3 billion and indicated we would increase them further in the fourth quarter. And that for us is saying, okay, the business is going like this and we're managing that way. But if we're wrong, I have a big buffer equal to 1 year of cost of risk to complement whatever hits me.
Well, that was the UniCredit Chief Executive Officer, Andrea Orcel. Now, amongst the guests we're speaking to at the World Economic Forum in Davos, the Chief Executives of Morgan Stanley and Bank of America, also the Director General of the World Trade Organization. But coming up, don't miss our interview with David Rubenstein, the co-founder and co-chairman of the Carlyle Group. A good conversation on private assets. That's next, and this is Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins this week, only on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, the Chief Executive Officer of Goldman Sachs International says the bank will continue to hire new staff selectively. I spoke to Richard Nodde earlier.
We've sized the firm to suit what we think the outlook will be. But of course, you have to be nimble. And I think it's important, particularly in a cyclical industry, in our industry, we continue to adapt to the environment. But looking ahead, we think we've got the firm to the right place now. I think importantly, we can continue to hire a lot of people. We're hiring over 3,000 people from universities this year, so we're going to bring a lot of new people into the organization. We'll selectively hire up and down the organization. So these cuts help us drive greater efficiency, help us size the footprint. Clearly, there's been some adjustment across some of our consumer-facing platform businesses, and so we think we're set, but we will continue to adapt to the environment as it unfolds.
Richard, what about compensation?
So we always try and match our compensation and the rewards for our people to performance. And last year was obviously a tougher year. We're very focused on driving returns for shareholders. We drove a 10% plus ROE for shareholders last year, but compensation and rewards for our people have to reflect overall performance. And clearly, last year was a tougher year than the year before when compensation was higher, and it's a cyclical business, and our compensation will continue to follow that trend.
So how much will bonuses be cut? And actually, do you think staff will take it badly?
I think our people have a long-term view. They're here to build a career, and they know that it's a cyclical industry. I think over time, it still offers terrific returns for our people. But you have to take a long-term view, and you have to look through the cycle, and you have to form a view as to what do you want your rewards to be over a cycle as opposed to any single year. And there'll be good years and there'll be less good years, but history has shown that you stick with it over time, you do very well.
Well, that was Goldman Sachs International Chief Executive Officer Richard Nodde. It's extremely interesting here in Davos to listen from various industries about, of course, not only the supply chains, but the reopening of China. I think my big speech here in the last 2 days, well, actually two big speeches. First of all, we heard from the Vice Premier, Liu He. He talked a lot about the reopening. He then traveled on to Zurich to meet with the Treasury Secretary, Janet Yellen. The other big speech, and he's the only G7 leader here in Davos, is Olaf Scholz with a message of optimism about the resilience of the German economy. I've had a couple of guests today saying, look, yes, we can be proud of what we've achieved, but it's going to be still a long road ahead, and it's maybe too soon for Germany to cry victory. Now let's also get to the Bloomberg First Word News. In London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. New Zealand's Prime Minister, Jacinda Ardern, says she's stepping down in a surprise resignation ahead of a general election later this year. Ardern, who was the world's youngest female leader when she took power in 2017, says she no longer has the energy or inspiration to seek a third term. Her ruling Labour Party will hold the first round of voting for a new leader on Sunday.
I know what this job takes. And I know that I no longer have enough in the tank to do it justice. It's that simple.
Now, Microsoft and Amazon have begun cutting a total of 28,000 jobs, part of a post-pandemic reckoning for the tech industry. Microsoft has started notifying some of the 10,000 workers that will lose their jobs this quarter. The 18,000 job losses at Amazon represent about 6% of the online giant's workforce. Both companies say the cuts are needed to offset slowing sales. And English football clubs have cemented their position as the leading revenue generators here in Europe. Manchester City took the #1 spot in Deloitte's annual Money League for a second year running, with 5 more English clubs filling out the top 10. Man City's revenue, up 13% last year, was boosted by a sharp increase in commercial income. Liverpool and Manchester United also made the top 5. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, disruption across France as strikes begin the government's plan to overhaul the pension system. We'll have plenty more on that. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance early edition. I'm Francine Lacqua here in Davos. I was going to say London. We're in Davos, but day 4, it's very cold, and there's been a lot going on. Now, the Oaktree Capital Management co-chairman, Howard Marks, believes the financial markets could be in the middle of a sea change not seen in 50 years. Well, he sat down with Bloomberg's Romain Bostic for an exclusive interview, and the billionaire investor says, well, investors need to get accustomed to normal rate environments moving forward.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way.
Well, do we go back? I mean, what do we go back to at all? Because when I sort of read that memo and I look at sea changes, it sounds like everything new is new. It's never really a reversion to where we were in the past.
Right. Well, that's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So, look, I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
Right.
So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
But so much of the agita in the market right now is, of course, people trying to figure out what that new rate is,
Right.
or if you want to call it a neutral rate or whatever.
Sure.
But, I mean, when was the last time that you could remember that we had a stable and persistent neutral rate?
Well, it depends on your definition of stable time-wise. But, of course, I think that the Fed became activist with the arrival of Alan Greenspan in the mid-'90s. And I think that it's, we had people started to talk about the arrival of the Greenspan put, that if there was a problem in the economy, the Fed would just squirt in some liquidity and solve it. And
they frequently did.
And they frequently did, including Y2K and other real and imaginary crises, the arrival of the bursting of the TMT bubble, for example. So I would say that that's 25 years that we haven't had what I call a free market in money.
But what gives you conviction that Jay Powell and whoever his successor might end up being are going to sort of move in a different direction, where they're not going to necessarily kowtow to the market in a way that the market has come to expect?
I'm applying common sense. You can't always count on common sense.
Yeah.
But the events of recent years tell me that it's not great to have interest rates at zero. Zero interest rates are really an emergency measure. Somebody gets a heart attack, you give them a shot of adrenaline. Works.
Right.
That doesn't mean you start your day with a shot of adrenaline every day for 7 years.
Right.
We had rates at zero for 7 years. And I think that, and by the way, by the time 16, 17, 18 rolled around, people started to say, well, shouldn't rates be a little higher so that if we have a recession, the Fed can cut rates and become accommodative? Well, if rates are a zero or a quarter or a half, you can't do that.
Yeah.
So I think that's an important reason why rates should be positive. And if you want to fight inflation and kill off inflationary psychology, which is very important, you need a positive real Fed funds rate.
Right.
That is, the Fed funds rate has to exceed the rate of inflation.
And we're
we have a way to go.
Well, that was Howard Marks, co-chairman of Oaktree Capital Management, speaking exclusively to our Romain Bostic. Now, despite higher interest rates, parts of the American economy are still going strong, gaining much from post-pandemic spending, especially in leisure and travel. That's the view of Blackstone Chief Executive Officer Steve Schwarzman, who sat down with David Weston here at the World Economic Forum.
Well, I think in the United States, we're obviously fighting higher interest rates, but we're doing it from the perspective of an economy that's in quite good shape. One of the reasons for that is an outcome of the pandemic. And during the pandemic, people stayed at home. What every country's government didn't figure out is the 90% who kept being employed would end up having way more money after the pandemic. Because their cost structure collapsed. They didn't go to movies, they didn't leave their homes, they didn't travel, they didn't buy expensive clothes. And that $2.5 trillion of extra money was in the banking system, and they've been spending that money. And that's been keeping the economy performing better than people expected. They've spent about half of it. Whether they spend the rest of it, whether they save it, but that's an extra stimulus, if you will, that's kept the U.S. economy moving ahead pretty well. The Fed, of course, is trying to do something with inflation, and they have to, assuming they really want to get it all the way down to 2%. So they've been very aggressive. Moving, and the question is, how much effect does that have? We're starting to see the economy slow down a little, and particularly in interest-sensitive areas. One would think it would have had more impact, but it hasn't yet. And the reason we've developed almost a two-part economy. Interest-sensitive areas, like housing, where new house construction is down 19%. Usually in a recession, it goes down 35%. So you can see how far we are away from the bottom. It's affected Wall Street and markets because when you raise interest rates very high from a percentage of where you started, it'll have adverse incomes. And there are other parts of the economy that frankly are still extremely strong, that raising interest rates hasn't affected yet. Stuff like travel. Airlines just can't even cope with the volumes. Resort hotels, people after the pandemic were so grateful that nothing worse happened to them, that they just want to celebrate and live life.
The Blackstone Chief Executive Officer, Stephen Schwarzman, speaking, of course, to us here in Davos at the World Economic Forum. Now, the question that we're trying to figure out today is not only the energy complex going forward, but, of course, is there too much optimism here in Davos? Just 3-4 weeks ago, when we didn't know that there was less predictions that inflation was peaking, but also when we didn't know that China would reopen really by 160 degrees, there was so much more concern. So there's one man who's going to come on with me. He heads all of our Davos coverage. He's Simon Kennedy. Also coming up, the Chief Executive Officer of Germany's Merck Group, Belen Garijo Lopez, will be speaking to me here in Davos. That's a conversation on not only healthcare, but government spending. This is Bloomberg. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, the European economy had, we all know, a challenging year in 2022, plagued by Moscow's war in Ukraine. Germany has been at the forefront of the crisis with its reliance on Russian energy. Now, speaking to us earlier, the EU Economy Commissioner, Paolo Gentiloni, says the bloc has managed the energy crisis better than expected, but Germany's economic future remains uncertain.
Technical recession, meaning 2 quarters with negative, is uncertain at the moment. I think this could be confirmed, or we could have surprising better data. It's not so different. It's a matter of point something,
yes.
The difference.
Yeah.
The point is how real is the perspective that after the first quarter we will restart growth in Europe. And in our estimate, growth will restart, but it will be very subdued.
Paolo Gentiloni, European economy, well, the EU Commissioner actually for economics, not the minister, speaking to me a little bit earlier in Davos. Now, we're joined by Simon Kennedy, Senior Executive Editor for Bloomberg Economics. I can also give you a promotion. Titles are changing, ever changing when you're in Davos and it's in the cold. So talk to me a little bit about the mood here. So it's quite optimistic. Given what we've lived through, but also given what these chief executives were thinking 3 weeks ago. Are they too optimistic?
Absolutely. I think what you're seeing here is that I think they want to believe, they want to find reasons for hope, and there are some reasons for hope. You've seen it in the interviews on this stage over the last few days. You've seen a better winter, a stronger Europe. The German Chancellor talking to us earlier in the week, optimistic about swerving a recession. The China reopening, a big theme earlier this week. The feeling that might deliver some bumpiness in the near term, but some longer term strength towards the end of the year. Geeta Gopinath of the IMF sums it up quite well yesterday, talking to you about how it's a tough year ahead, but that we're going to see gradual improvement. And so when you talk to executives, when you talk to the bankers, this tentative, this cautious optimism, this wanting to believe comes through.
Yeah, so what are they most optimistic about? Because I keep on hearing, look, it's the reopening of China. Are they underestimating the hike in inflation or the spike in inflation that we get from that?
So it's you're looking at the same data with different lenses. So for them, the peak of inflation has passed, they think. The slowing of inflation is coming. That will prompt the central banks to maybe pull back. Bloomberg reporting earlier in the week that the ECB may do that in coming months. A lot of people thinking that the Fed, in just a couple of weeks, will embrace a slower pace of rate hikes. So they're hoping that slow inflation means fewer hikes from the central banks. They're hoping that the China reopening leads to this splurge in demand worldwide via tourism, via manufacturing. Put that all together, you can get quite a nice outlook from that. But again, as Larry Summers said yesterday about the US debt ceiling, hope often triumphs over experience, and I think that's probably a good theme for overall Davos, because again, there's all these risks. There's the war, there's geopolitical differences, there's the coming fight over the debt ceiling, there's inflation, there's the interest rate hikes, and you could be, if you're a central banker if you're a central banker here, of which there are many, you could come to Davos and go back to your office and go, actually, if these guys are more optimistic, we're going to have to keep hiking because inflation's not coming down. Again, a theme yesterday. Raghu Rajan, formerly of the Reserve Bank of India, saying central banks and fiscal policy aren't aligned. That's going to take a while.
I mean, it's amazing actually to see that the participants here, and every year they're in flux and they change. So we don't have anyone from the G7 apart from Olaf Scholz, but there's a very big contingent from emerging markets. Is this their year?
Absolutely, and it's mainly it is an emerging market event to some extent now. You have to obviously see a lot from Latin America, a lot from Africa. Even the frontier markets are well represented here. And if you read John Authors on Bloomberg today, the emerging markets so far are the big winners into 2023. And again, that's another force for strength in the world economy. If you have these kind of smaller growth engines starting to power upwards, that also helps lift the world.
So very quickly, you lead all of our coverage. So it started by TV and beyond. Now we have newsletters, we have, of course, social media, we have like 6 or 7 cross platforms. What's most popular? What do people want to know about, from Davos?
So I think what they want to know about is what we've just talked about. Is they want what's the big message coming off the mountain, but they also want those interesting stories about they want those as well. But I'm not sure we're the home for those. But they also want to know about artificial intelligence. They want to know about the 4-day work week, quiet quitting, these new trends, or perhaps old trends, which are now getting into the main stage.
Simon, thank you so much. And you can, of course, follow all of that coverage. And as Simon was saying, there are very different strands to this. You can go on the terminal, the website, and we have like 4 newsletters also coming out. Now, French unions are taking part in a nationwide day of strike actions against the government's plans to revamp the pension system. Let's bring in Bloomberg's Caroline Conan outside the Gare Paris-Saint-Lazare for more. So, Caroline, what disruptions do we actually expect in France today?
Francine, it is the first day of the general strike against the pension reform announced by Emmanuel Macron last week, and it is expected to be very painful. These are the words of the transport minister. We expect some disruptions on the trains, in the air, with the planes, but also in schools, in hospitals, oil refineries, and even some nuclear sites. To give you an example, for example, I'm in front of the Gare Saint-Lazare. You have some TGV high-speed trains. There's not going to be more than 1 in 3 trains today running across the country. And for the regional trains coming from here at Saint-Lazare, only 1 in 10. So you can imagine it's going to be very difficult for the French and those who have children. Also, this is going to be a challenging day because 70% of the teachers are on strike today. This afternoon, I'm going to go and see the protests in Paris. The goal of the union is to reach at least 1 million French people in the streets today.
Well, that's something that a lot of the French people will have to live with. Here in Switzerland, I have to say the trains are not only running well, but also on time, which is surprising when you come from some continental European nations. Caroline, thank you so much. Great reporting on the ground there in front of the Saint-Lazare station in Paris. Caroline Conan. Now, coming up, the Chief Executive Officer of Germany's Merck Group, Belen Garijo Lopez, will be speaking with us here in Davos. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition, and Francine Lacqua here in Davos. Now, let's get to another key interview here from the World Economic Forum. Joining us now is Germany's Merck Group Chief Executive and Chair, Belen Garijo Lopez. Thank you so much for joining us. I know this is, Merck, and actually for those who don't 100% know, the company has 3 main divisions, and those are very different divisions. Of course, it's life science. Of course, it's also biopharma, but electronics.
Yes.
Out of those 3 businesses, what do you think will outperform in the year or two, in the next year or two, given the changing economy?
So, first of all, thank you for inviting me. It's a pleasure to be here. Well, first of all, let me start by saying that we are a globally diversified company, and that diversification is a very, very important pillar of our resilience over the years. So the 3 businesses have been performing very nicely during 2022. We have communicated figures in Q2 in which we delivered strong growth. Our main growth driver in Q3 for both revenue and profit was life science, followed by healthcare. Electronics is influenced significantly by the downturn, by the cool down of the display market in
supply
China.
chains?
Not so much. It's basically, I mean, we are driven by semiconductors in electronics, which is a very strong, solid, which is delivering very strong, solid growth.
Yeah.
But of course, the end market of smartphones went down and computers went down significantly after the pandemic, and this influenced negatively our display business, right? So despite the good performance of semiconductors, electronics was a bit down in Q3.
I think in your Capital Markets Day, you were saying that you are ready to do acquisitions, even sizable acquisitions, as soon as 2023. Are you still of that view? Is it because of valuations or just opportunity then for growth?
Let me once again repeat that our midterm ambition of delivering 25 billion by 2025 is secured with our organic growth. We are heavily investing in expanding capacity and in really regionalizing our footprint. And we don't need to make an acquisition to deliver on that ambition. But we have, in relation to our great operational performance, we have enhanced our financial position, and now we have a capacity of between 15 and 20 billion euros that, of course, could eventually contribute to accelerate the growth of our businesses.
And now is a good time because of cheaper valuations and some of the headwinds, or is it a risky time?
Look, valuations are still high, both in biopharma and life science in particular. So we are, you know, our M&A strategy may be taking different forms, and we are going to keep our optionality. We have already done bolt-ons to acquire new technologies, mainly in life science, but also in biopharma. And we will continue to do so regularly.
But is there a specific, you know, given your three divisions, is there a part of the business that you think would, you know, take more advantage? Is there something that you're after, that you're looking at the moment to acquire?
Our capital allocation is absolutely sharply focused on our three pillars of growth. And this is process solution, CDMO, so services, life science services, and the healthcare pipeline, and semiconductors. We will continue to groom this pillar, and we have announced already significant CapEx investment every year to fuel that growth. Now, when we look at M&A, we are scanning the market permanently, right? And we value life science because life science is highly predictable and very stable, highly attractive markets. And of course, biopharma and biotech will continue to heavily invest on developing biologics and pipelines, also novel modalities, and this is our sweet spot.
I want to talk to you a little bit about the future of work, but the future of hiring. So you were on a panel and you said something has changed, right, in the way you want to hire, so that it's not about experience, but it's about attitude. When did that happen, that change, and how you look at hiring and what the type of talent you want to attract?
This has been, I mean, talent is more important than ever before. Right? I think Merck is a caring organization, people-centric, and of course, you know, in the last few years, we have become even more attractive because of our diversification and the company, the values-driven company who we are. People, you know, you implement through people. There is no good strategy. You always implement through people. So building a high-impact culture became a key dimension of our enterprise strategy. And in that context, not only voicing clear leadership expectations, but also raising the bar on talent became a priority.
But it's difficult. So attitude, is it in interviews? Like if you get, I don't know, 200 CVs for a position, what are you looking for if it's not experience? Like what makes the difference in a CV that catches Merck's attention?
Look, we are not only relying on interview to make people choices. I mean, people would ask me, what is the most difficult decision you make? And they would expect that I say capital allocation decisions, actually making people decisions.
Who you hire.
Who you hire, who you develop. Who are you focused on retaining is one of the most difficult decisions that leaders make. So there is, you know, the importance of people have grown during the pandemic, and having a very robust people strategy in which talent is the main pillar has been my obsession. So you see, you cannot do new things with the same experiences, right? First of all, there is an emergence of new capabilities like data scientists, engineers, not the traditional pharma or life science profiles, right? So we have acknowledged this and integrate that into our strategy. And it's not interviews. Attitude and leadership is always what help people raise the bar and deliver.
Thank you so much for a great conversation. We need to talk about this a lot more because I think it's probably one of the things that chief executives worry about the most is, of course, retention of talent, but also how you pick the talent that you want to make sure you keep in the company. Germany's Merck Group Chief Executive Belen Garijo Lopez there. Now, JP Morgan Asset and Wealth Management Chief Executive Officer Mary Callahan Erdoes says the Fed is doing its job effectively in the face of continuing price rises. While she spoke with David Weston here in Davos.
It's a funny thing when people say inflation has peaked, it's not. Inflation is just going to grow slower. We still have, goods and services that are up 15% over the past 2 years cumulatively. And so if you only grow at 4% for the next 2 years, you're going to find yourself at things that are up 25% from where they were before we started this. So that's a lot to digest. And wages have to keep up with that. Savings have to keep up with that. We've had nice cushions, particularly in the U.S. consumer. We bank half the households in the United States of America through Chase, and we can see a lot of the actual data. There's been a nice cushion of days of cash on reserve in people's accounts. But that's depleting, and for the lower income, it looks like that might get back to pre-COVID levels of about 19 days worth of cash excess. By the time summer comes, that's not a lot of cushion to be able to think about where that money needs to be spent. And when prices continue to increase, you need to have the system in balance. So, the Fed is doing its job effectively. The Fed funds rate is even higher than what it may appear to be. There's some studies that show that it may be as high as about 6.5% effective in the world. And so the whole world is priced off of fixed income. It's priced off of what is the discount rate you're going to use on future earnings. So that's the most important conversation that we're having. But thankfully, we're having it with yield back. And so, bonds have always been a very important part of the conversation, but with many of them negative yielding for the past several years, it's a much better time to think about bonds in the portfolio and a positive contributor. And so I think we're going to have a better sledding going forward.
Which takes us back to your portfolio. As you say, it's got to be balanced, and you referred to 60-40 before. When you have the discount rate really going up, it favors bonds. Does it disfavor equities? Is this a bad time, actually, to really be doubling down on equities because that discount rate is going to discount your future cash flow?
Yeah, I think most of that's fairly priced in. It's going to depend on where things go on any given day. It also depends on currencies and how you think about that. But most importantly, it depends on profitabilities of companies. So they have to go back to being profitable. You're seeing companies rein it in a little bit. Lots of announcements coming out over the past couple of days. And so on the margin, people are going to be really fine-tuning how that works. And those that continue to show profit and growth for that, they should be rewarded with high PE ratios. And those are the companies you want to invest in for the long term. And this is really about long-term investing. So that's the focus. That's what people have to keep their eye on. And that's what we spend a lot of time doing at JP Morgan.
Well, that's JP Morgan Asset and Wealth Management Chief Executive Officer Mary Callahan-Erdoes speaking with David Weston. Now, coming up, we'll have plenty more from Davos. America's climate envoy says Europe should boost its green spending to match the U.S. We'll hear from John Kerry next. This is Bloomberg.
The biggest frustration right now with respect to moving rapidly in dealing with the climate crisis is the lack of available concessionary funding that can be made as a grant or that can leverage other money to be invested in order to accelerate the transition. We really need to find new ways of attracting capital to the table. One of them is with a blended finance approach where we get public money that can de-risk a deal so that the private sector can come in and not feel it is at risk to such a degree that they're not willing to make the investment. President Biden is, I know, committed to trying to effect some reforms with respect to the multilateral development bank structure. We think there's a lot more lending that could take place at lower rates that would be helpful to countries. So there are definitely things we can do. But in the end, the private sector is the one entity that has the levels of funding that need to be invested in this effort.
Well, that was the U.S. climate envoy, John Kerry, with, of course, a good conversation on me. And this was on the back also of Janet Yellen and Liu He of China talking about more cooperation in terms of finance availability for ESG. Now, let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. The Total Energy CEO is urging French motorists not to panic buy fuel ahead of strikes over a government plan to overhaul pensions. Diesel and petrol deliveries are set to be paused as part of a 24-hour walkout across France today. The strikes are expected to disrupt everything from energy production to manufacturing as labour unions protest Emmanuel Macron's plan to increase the retirement age. Now, Blackstone has raised a record $22.2 billion for a fund that will acquire stakes from pensions, endowments and also other investors. The haul, which far exceeds the firm's initial target, is the biggest secondaries fund ever raised. It comes as a private equity giant further expands beyond its buyout roots. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you. Stay with us. Many great interviews from Davos still to come, including the head of the World Trade Organization, Ngozi Okonjo-Iweala. This is Bloomberg.
The days of us raising them 75 basis points at a time have surely passed. In my view, hikes of 25 basis points will be appropriate going forward.
A slower pace is just a way to ensure we make the best possible decisions. We can, and if necessary, should adjust our overall policy strategy to keep financial conditions restrictive, even as the pace slows.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. It's a record start to the year for bonds. That's led to an unprecedented debt sale bonanza by governments and companies around the globe. Labour unrest across Europe. Strikes in France today may bring much of the country to a standstill. In the UK, almost 500,000 workers plan to walk out on February 1st. And a shocking announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down months before a general election. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, yesterday in the US, today in Asia and Europe, it seems the day that bad data in the US started to really weigh on sentiment and get people thinking about how weak things could get for the global economy rather than just inflation.
Yeah, this idea that maybe bad news is finally bad news again if it means that the growth outlook is deteriorating more rapidly as policy has tightened around the world. That is definitely something markets have continually contended with, and that definitely was true in Asia overnight, where stocks broadly were lower. The MSCI Asia Pacific Index down by about 0.5%, but really the losses were led by Japan, which is kind of a separate story. The Nikkei 225 was down about 1.5%. That reversing a large part of yesterday's gain, and that probably has a lot to do with the reversal we have seen in the Japanese yen. Remember, yesterday the BOJ kept its policy settings unchanged, defying the expectations of traders. We saw some remarkable weakness in the yen, and then by the end of the day, it had recovered a lot of that, and it is now strengthening against the U.S. dollar today by about 4 or 0.5% at 128.32, making the yen the best performer in G10 against the dollar today. One of the worst performers against the dollar is the Kiwi, the New Zealand dollar, weakening by about 0.9% to just under 64 cents on the dollar. And of course, that is in the aftermath of that shock resignation announcement from the Prime Minister, Jacinda Ardern, which Anna mentioned, Matt. And of course, we're going to have more on that in just a couple minutes.
Yeah, I've been talking about it too. What happened over there in New Zealand? Here in the U.S., we're looking at a loss on futures of about 0.4%. We did close the cash trade down 1.5% yesterday, as Anna says, after that retail data came out. Really, I guess, highlighting concerns for investors that we could run into a recession. We had the biggest drop in retail sales in a year, and we also downgraded the prior month's retail sales. So maybe the consumer isn't holding up as well as we thought, or at least tightening its belt. You see the 10-year yield, it really slid over the last couple of days. I think about 35 basis points if you look at it, because we were up at 365 just a few sessions ago, and now we're at 335. So right now, offering not a very competitive yield to stocks. Nonetheless, the recession fears have investors in sell mode. NYMEX crude, which had been approaching Brent levels, you remember yesterday or day before I was saying this isn't Brent because we were up well over 80. Now we're back down to 78.50. Of course, those recession fears make one worry about demand in the oil space. And then Bitcoin coming back off of its highs. So we were up well over 21,000, back over the FTX prior to the FTX explosion levels. Now we've come down. Right now you see a little bit of a gain, just 0.08%, but we actually had two back-to-back days of losses, snapping the winning streak in Bitcoin that we've seen throughout the beginning of the year. Anna, what do you see in Europe?
Yeah, the European equity session then, Matt, dominated by that negativity around that data over in the US, really. So three pieces of data weighing on sentiment yesterday in the US. That's come through into the European session, or continues to do so. And we see European equity markets down 0.6%. It's quite broad-based, actually. Most sectors here in Europe are in negative territory, just the likes of healthcare and food, beverage, tobacco. Those were the ones that in the early part of today were doing a little bit better. This is one of the sectors on the back foot, down 2.5% on basic resources, the mining sector. That weighs on the London story, of course. When we're nervous about global growth, we're nervous about mining stocks, and that weighs there. Brent crude, the same story. It's the Brent crude price at 84.16, down another 1%, and that again is to do with concerns around global growth once again. The French two-year yield I've put in here, we're actually seeing some movement higher in this yield, some selling at the short end of the European curve, and this is really to do with the ongoing pushback we're getting from ECB officials about the idea that we step down in those hikes from 50 to 25 basis points in the European context. Yesterday it was the Bank of France pushing back. Today it's Klaus Knot at the ECB. So there's a lot of that kind of thinking, moving the markets around and resetting expectations for the ECB a month or two out. And this is the euro on the rise against the Norwegian kroner. We heard from the central bank over in Norway, the Norges Bank, holding pat on rates, standing still on rates there, Matt. But that's not the end of the story. They do say that further rate hikes will be coming, maybe in March. That seems to be the thinking at the moment. But they're also talking about doing those hikes at a more moderate pace. And as a result, perhaps we see a little bit of movement in the currency, Matt.
All right, the euro gnocchi, that's pretty wonky. I like it, Anna. Let's get to New Zealand, though. A surprise announcement down under. Prime Minister Jacinda Ardern is stepping down before a general election later this year.
This summer, I had hoped to find a way to prepare not just for another year, but another term. because that is what this year requires. I have not been able to do that. And so today I'm announcing that I will not be seeking re-election, and that my term as Prime Minister will conclude no later than the 7th of February.
Bloomberg senior reporter for international affairs, Mark Champion, joins us now. So, Mark, what happened? What do we know?
Well, I think there are two things. First, I think, we should take at face value the fact that, when she said that she just didn't have it in the tank, it's a lot to get yourself together to run again for Prime Minister. And the second thing, which probably was decisive, is that she is trailing in the polls. She's got a real uphill battle in order to win again, and I suspect she just decided she didn't want to do it.
Well, and Mark, we have to keep in mind as well that Jacinda Ardern, while representing a relatively small country, New Zealand has, a handful of 1 million people. I believe the population is significantly smaller than that of just here in New York City, where Matt and I are, and yet she was a real voice on the global stage. Is whoever replaces her likely to have that same amount of influence, or was that unique to her?
That was absolutely unique. I mean, she was a really interesting character. As you say, it's a very small country, quite remote, and yet she managed to stand for the kind of liberal values that are sort of fading in a lot of other democracies. She just carried on, and in a way, she's the sort of representative for liberals and progressives in other countries who kind of wish we'd had a leader like that. At various points, there were sort of various crises that she responded to, a mass killing, where she immediately imposed gun controls. Another with the COVID crisis, where she slammed hard controls at the beginning of the crisis, seemed to do very well, but later on, the story has now become an economic one, where like the rest of the world, New Zealand has high inflation. The economy is just not doing as well, and she's fallen behind in the polls to the National Party, which has a very traditional conservative message, which is we can get the economy going again, and the Liberals cannot.
Mark, thank you very much. Our senior reporter for international affairs here at Bloomberg, Mark Champion. Yeah, maybe we take those polls at face value. Certainly somebody who managed to cut through during the pandemic on the international stage. Now, Europe on strike. Almost 500,000 workers in the UK are set to walk out on February 1st. In France today, unions aim to bring much of the country to a standstill in response to Macron's pension reforms. Bloomberg's Caroline Conan joins us now from the Saint-Lazare train station in Paris. Caroline, what disruptions do we expect to see then in France today?
Anna, the pension reform announced by Emmanuel Macron last week has angered a lot of French people. So this general strike today is expected to be very painful. This is according to the French transport minister. For example, right here from Saint-Lazare, you have some national trains, you have some regional trains. About 1 in 3 high-speed TGV national trains will run across the country, 1 in 10 regional trains. So you can imagine how difficult today this is going to be for a lot of the French. And for those who have children, even a more challenging day, because 70% of the primary school teachers are on strike today. We will also expect some disruptions in oil refineries. You've seen some French people queuing again at the petrol stations because they were worried that they would run out of fuel over the next few days. And finally, there will be some disruptions in terms of electricity production with some reduced capacity expected to be equivalent to about twice the consumption of Paris, the capital.
Okay, so it sounds pretty chaotic, Caroline. What does this mean for President Macron? Will he back down?
it will depend on how many people actually descend on the streets and protest. There's going to be protests and marches across the country today. I will go at the protest in Paris this afternoon. Unions expect to gather at least 1 million people in the streets. But of course, even if 2/3 of the French people are opposed to this pension reform and to raising the retirement age from 62 today to 64, that doesn't mean that everyone will go down and descend on the streets. So we'll have to see if it's more than 1 million, it's a victory for the unions. If it's less, it could be a victory for the government and President Macron.
Caroline, thank you very much. Bloomberg's Caroline Coe now with the latest on the Labour story out of Paris. Now, the best start to any year for bond returns is helping fuel an unprecedented debt sale bonanza by governments and companies around the world. Global bond sales have hit nearly $600 billion in 2023 so far. Bloomberg's markets reporter Valerie Teitel is here to take us through where all the issuance is coming from. And Valerie, it seems you can't move for investors saying they've got appetite for bonds right now, and now it's being met by a whole wave of supply. Where's it coming from?
Yeah, you're right, Anna. Investors are just gobbling up, and it is all over the place. In Europe, it's mostly financials. In Asia, it's dollar corporate debt. That's on the tailwind of the China reopening narrative. And we're also seeing a decent supply in emerging markets. We have some impressive stats. The issuance so far, it's only been 2.5 weeks in January, equals 40% of the total issuance from 2022. It's a 250% jump on the issuance versus last January. And let me take you through some of these deals. Saudi Arabia came to market with a $10 billion deal. It's the largest EM sovereign deal in 3 years, Anna. It's a slew of emerging sovereigns behind it in the pipeline. Some of that is not surprising, given EM countries have some of the highest real yields out there. And a lot of them, look, they hiked before the Fed did. Their economies are faring fine. And if the Fed is going to be cutting rates at the end of this year, it could be a huge tailwind for EM fixed income.
Hey, Oaktree co-founder Howard Marks was on Bloomberg television yesterday. He said he thinks financial markets may be in the middle of a third sea change. Listen to what he told Romaine Bostick.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there.
All right, so, things are going to be different this time. Do you see that in evidence in the data?
Look, he raises a lot of good points, but I'd argue that junk issuers, like he was talking about, took advantage of the low yields in the past and really extended the maturity, extended their debt profile. They're sitting on quite healthy balance sheets. And secondly, it's all about supply and demand. With such little junk bond supply in 2022, as a lot of those junk issuers were kept out of the market by volatility, there is a lot of pent-up demand behind it. We're seeing that especially in the most riskiest bond ratings. Double-digit yields, they're just enough to stomach the risk-reward to some. But look, I agree, further margin pressure on an economic slowdown, that is the key downside risk, but it looks like there is demand out there and issuers are meeting it.
All right, Bloomberg's Valerie Teitel in London, thank you so much. And of course, a potential economic slowdown is a topic of conversation at the World Economic Forum in Davos. So let's go there now. Wall Street Week anchor David Weston is there with the head of the World Trade Organization. David.
Yeah, thank you so much, Kelly. As you say, trade is so important to global Wall Street. That's why Wall Street Week is here today. And we're delighted to have the Director General of the World Trade Organization. She is Ngozi Okonjo-Iweala. So, Director General, thank you so much for being here.
Thank you, David.
A lot of talk here about global growth, and that's so dependent upon trade. We've heard from the World Bank. They're taking their estimates of global growth down. Where is the WTO in terms of global growth, particularly in trade?
Well, I'm afraid our own forecasts are also on the downside. We are going from 3.5% growth of merchandise trade last year to 1% this year. So that's a considerable drop. So it's very much in line with the lower forecast for GDP global growth that we're seeing.
We're seeing China reopen, which may be helpful to the global economy. We also saw Liu He, the Vice Premier, meet with Janet Yellen, the Treasury Secretary, over in Zurich, Switzerland, earlier this week. What are the prospects, perhaps, for China coming more, if I can put it this way, back online and helping some of those trade numbers?
Well, look, there's quite a bit of optimism that is being attached to the opening up of China. And I think the meeting of Belen and Allaire is a good sign, but I think we should also keep it in check. You know, we always swing from one extreme to the other. China, certainly, its opening up will contribute, and we will see Chinese consumers, you know, their demand will go up for goods, and hopefully the factories will open up. And with what we are seeing in terms of freight costs coming down, supply chains becoming, you know, more functional, there's some hope for things to improve. But I just want to put a caution, because there's a lot of uncertainty around that. You know, we have many uncertainties, not only within China as to the trajectory of the pandemic and what will happen, but also we still have the war in Ukraine going on. We still have the issue with food prices, energy prices. So I would put some caution around it. There are a lot of uncertainties.
What about the larger, longer track of trade? Globalization has been a subject at Davos, Switzerland, for many, many years. And I won't say we're going away from globalization, but it certainly is changing as we see perhaps not global things, but blocks form. Yeah. What is that doing? Do you see that phenomenon, and what is it doing to trade?
Well, it's important to note that trade will be central to any recovery. And even though we see the goods trade, the growth of goods trade decelerating, volumes are high, and even trade between China and the US and between China and the EU, you know, they're at record highs. So let's keep all that in perspective. Trade is going to play a central role. I just want to say that one interesting phenomenon is the rise of the digital services trade. That is growing at phenomenal rates, and we've gone from about $1 trillion in 2005 in terms of value to 3.5 trillion or thereabouts now. So I say trade is central. That's why it's important to be careful what we do in terms of fragmentation. When we talk of decoupling and fragmentation, I'm realistic. I know the geopolitical tensions are there, but the costs of the world fragmenting into two trading blocks, very high. We've actually done some simulations of this at the WTO, and we've seen that if we break into two trading blocks, the world global GDP is going to decrease by 5% in the longer term. Just think about that. OECD countries lost 3.5% of GDP during the financial crisis. This is more. You're talking of the economy, losing the whole economy of Japan, for instance. So this is something we need to be careful about. Now, do we need to diversify supply chains because we've seen vulnerabilities? Absolutely, but how we diversify is important.
We have the issues of globalization and trade. We also have climate and addressing climate. And I wonder if those two may be butting up against one another. We have the Inflation Reduction Act with special subsidies inserted to try to really start the green economy in the United States. We see Europe very unhappy about that. What is your take on that? Is it healthy in some sense to have that sort of competition to get to green faster?
Look, countries trying to get to net zero by 2050 or earlier is an important thing, because climate change is real and we're living with the consequences. How they do it is what we need to look at. And of course, from the standpoint of the WTO, we see the EU and South Korea, they have some issues with the way the Inflation Reduction Act is being done. What we've said to them from the point of view of the Secretariat of the WTO is to encourage dialogue. It's far better for them to speak to the US and try to resolve this and see if there's any way to take account of their concerns than to come to the dispute settlement system of the WTO. So that's what we are encouraging them to do, and I think it's working. They are talking to each other.
So finally, I want to address a book that you've written, Women in Leadership, co-authored a book that featured in part the Prime Minister of New Zealand, Ms. Ardern, who is now announced she's stepping down. What do you make of that? What about the Prime Minister herself and the fact that she said, I just can't keep going at this level? What does that tell us?
First of all, she's a terrific leader. I saw her not so long ago in New Zealand when I was there. She's done a very good job, and I think she's made women proud. The fact that she's stepping down, it just speaks to the fact that, let me put it in a positive fashion, women know when to step down. When they think they've given their best and they're ready to go, they say so, and we shouldn't overread anything into it.
Well, now that's pretty interesting, the idea that one of the things women do better than men is know when to step down, because we've seen some prominent examples, particularly in CEO suites, of men having a tough time stepping down.
Absolutely. I think women I'm going to take a risk and say this. Women have, their egos are lower. They have many more things to get on with when they leave work. Work does not define them. So I think it's a little bit easier for them. And I hope I'm not generalizing, because obviously there are men who are the same, who can do the same thing. But I think she set a good example, don't you?
I don't know if I have an opinion, but it sounds right to me.
Yeah.
Thank you so much, Madam Director General. Really good to have you here. That's Ngozi Okonjo-Iweala. She's the Director General of the World Trade Organization. And now back to you, Anna.
David, thank you very much. Wall Street Week anchor David Weston there with the WTO Director General in Davos. Really interesting conversation about global trade at a crucial time, of course. Coming up, more from the World Economic Forum. We will hear from Guggenheim Global's CIO, Anne Walsh. That conversation coming up shortly. And the CEO of the stablecoin issuer Circle will be with us. Jeremy Allaire joins the programme a little bit later. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos. He said the additional weapons will be used to target Russian forces occupying parts of Ukraine, not inside Russia itself. Citigroup is raising compensation for junior investment bankers by up to 15%. That comes at a time when many Wall Street firms are cutting jobs and slashing bonuses because of a drop in deal making. Citi's pay hikes will go to associates and vice presidents as well. It's a sign of banks' ongoing struggle to retain staff. The world's largest hedge fund says it is strongly bullish on short-term Chinese debt. Bridgewater Associates' all-weather fund reaped a 7.4% gain last year. Diversification across multiple asset classes helped Bridgewater expand in China's local hedge fund industry. It's now doubled assets under management. And Apple plans to take on Amazon and Google by expanding its smart home lineup. There will be new displays and a faster TV set-top box. That comes after Apple relaunched its large HomePod speaker. The new product line will start with a tablet that can control things like thermostats and lights, show video, and handle FaceTime chats. Coming up, we will head back to the World Economic Forum in Davos, Switzerland, and speak with Guggenheim Partners Global CIO, Anne Walsh, about the global economy, markets, monetary policy, and where we go from here. That's coming up next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's a record start to the year for bond returns. That's led to an unprecedented debt sale bonanza by governments and companies around the globe. Labour unrest across Europe, strikes in France today may bring much of the country to a standstill. In the UK, almost 500,000 workers plan to walk out on February 1st. And a shocking announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down months before a general election. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, US equity markets yesterday and European ones today losing ground, really, because of fears around global recession.
Yeah, absolutely. After the economic data that we got out of the U.S. yesterday, especially retail sales and the big slowdown there, you had a drop in the markets. The cash trade was off 1.5%, and now we're looking at futures that are down this morning. Right now, a little bit more than 0.5% on the S&P. The 10-year yield also sliding down to 3.35, so off just another basis point today. But yesterday, the drop was pretty significant. I think about 20 basis points in one day at one point in the session. And we also have a drop in NYMEX crude, down 1% to 78.69 for West Texas Intermediate, so falling back below into the 7 handle from the 8 handles. And Bitcoin coming off again for a second day in a row, $20,758 after a 14-day winning streak. Bitcoin breaks that up streak. Kailey, what do you see in terms of pre-market movers this morning?
Well, there's a lot going on beneath the surface because there is earnings season. There's also some analyst action to talk about. Alcoa, the big U.S. aluminum maker, one of the companies that reported after the bell yesterday. EBITDA coming up way short of expectations. Plus, the company is saying that shipments are going to be a lot lower than previously anticipated this year because of the uncertainty around the economic outlook and a deterioration in demand. So that stock is down about 6%. Also down about 6% is Roblox, the gaming company. It was downgraded over at Morgan Stanley. The analysts there are seeing slower bookings growth, also little upside from ads in the near term, so that is weighing on the stock. It's a positive analyst move, though, for CureVac, of course, the vaccine maker. UBS upgrading this stock, saying its announcement earlier this month about its messenger RNA vaccine for the flu and COVID-19 was a significant de-risking event. So that stock is up nearly 10% before the bell. And finally, I just wanted to check on Netflix because this will be reporting results after the bell today. This is a stock that has nearly doubled since its low in 2022, Anna. So the bar is going to be probably pretty high in terms of subscribers and the outlook for that ad business ahead of those results. That stock is down about 0.25% before the bell.
Okay. Certainly one to watch then, Kailey. Here in Europe, we have a negative picture for European stocks, and things seem to be worsening a little bit as we go through the session, down by 1.1% now on European stocks. One of the main losing sectors is the basic resources sector, so mining stocks down by 2.5%. And actually, it is, though, quite broad-based, so most sectors in Europe are in negative territory. The big global conversation has been about buying bonds and some of those yields coming down, as we've talked about recently. Here in Europe, though, at the short end, we're seeing yields go higher, and this has to do with the ECB expectations in the very short term. Over the weekend, or just into the weekend, we had that story here at Bloomberg about whether we might see a step down from 50 to 25 basis points in terms of hikes from the ECB. That got some pushback from the Banque de France, and today it got pushback from Klaus Knot at the ECB. So a number of ECB voices pushing back against that idea of a step down, so giving us some more hawkishness. And here's my wonky currency pair for the morning, the euro NOK cross. We've got the euro up by 0.6% against the Norwegian currency. The Norges Bank holding pat on rates, so no move on interest rates. That was widely expected. They are saying, though, that there could be more hikes to come, and March would be probably where they would do that if we do see some further hikes coming, Matt.
All right, Anna, thanks very much for that. Now let's get back to Wall Street Week anchor David Weston. He is sitting down with Guggenheim's global CIO, Ann Walsh. David?
Thanks so much, Matt. Yeah, but Wall Street Week is coming because Global Wall Street's here, and that certainly includes Guggenheim. So, Ann, really great to have you with us, the CIO. So, Ann, first of all, talk about the possible downturn, globally or in the United States. A lot of talk about that in Davos. How do you see it, and what likely effect could that have on credit?
Thanks, David, very much for having me. So, where we are in the cycle right now is we see a recession coming in the middle of this year. Now, we've actually heard a lot of optimism here in Davos, but at the same time, we know certainly in the U.S., the Fed's been continuing their quantitative tightening. They have continued their rate hikes. We anticipate, and the market's pricing in, another 2 rate hikes here in the first half of the year, along with the reduction of the balance sheet, which is not getting a lot of attention. You know, you've asked about credit. As we go through a recessionary cycle, what we can anticipate happening is that revenues will decline, margins and profits will decline. And as a result, credit will get a little bit choppier. We've seen a nice rally so far year to date. It's been refreshing change since 2022. But as we go through this cycle, we could anticipate spreads widening and there becoming more credit risk. In particular, one of the areas that we're a bit concerned about would be the lowest rated credits. And that would be both in high yield as well as in bank loans. So I think that's going to be an area for us to watch.
What are you seeing there particularly? We hear about so-called zombie companies who don't have enough cash flow to really service the debt, and they get squeezed pretty hard. And if they've been borrowing at essentially 0% interest rates, that's okay. If they have to roll over that credit at higher interest rates, are you seeing pressure on some of those companies yet?
Not yet, but we have to realize that we are seeing an incredibly large paradigm shift in the markets. We've gone from a QE world to a QT world. And that QT world is going to continue until the Fed's able to actually conquer inflation. Those companies that had ready access to capital and credit are not going to have that same access going forward. In fact, as capital gets rationed, those companies are going to suffer. So while we're coming into this cycle, and I think there's a room for some remaining optimism, and as we've seen here in Davos, but what's going to happen is that those companies that have had a tailwind in credit, up in credit ratings, access to capital, great earnings, even the zombie companies have had a nice tailwind, that's going to shift. And as we go through a recessionary timeline, we start to see that happen.
What about private credit? We had, I believe, an enormous growth in private credit, particularly with some of the regulations that were put in after the great financial crisis. What is the effect of the downturn that you anticipate potentially on private credit?
So private credit is a very large label for privately issued in the debt markets. And like any other market, there are participants who know exactly what they're doing and underwrite credit properly, and there are going to be participants that, because of quantitative easing and because of ready access to capital, have made poor decisions. And just like zombie companies that have attracted capital, we're going to see the same problem. The challenge with private credit, though, is it's private, and the transparency just isn't there for the markets yet.
Well, that was going to be my question. Will we know they're having trouble, and will we know in time? Because we won't have the same information, as I understand it, as we would from some of the public sources.
Well, that's true. And we have something we tend to call crisis at maturity, which is you don't know until you get to the very end. And I think that's going to be a challenge for the credit markets.
So break it down, if you could, between investment grade and high yield and leveraged loans. Given what you anticipate, where do you want to go? Where do you want to stay away from overall?
So at this point in time, we are repositioning our portfolios to move up in credit quality. As we go through a recession and spreads widen, they're going to widen less in investment grade credit. These tailwinds that I spoke of are really going to be a benefit for investment grade credit in particular. We avoid and are avoiding the lowest rated, CCC rated, or some of those what I call dicier credit or unitranche credit transactions that combine senior and subordinated credit together. And those are the areas where I think there's going to be hidden risks. They're also more correlated to the equities markets. And as we go through a recession, we would see equity markets decline as well. And so that's why we're repositioning into investment grade credit. The one thing that's helping us, of course, as we've come through this rate hike cycle and quantitative tightening, is the Fed's put the income back in fixed income. So that trade makes sense now.
Exactly. Make some money on that debt. And you're the chief investment officer for Guggenheim. And you succeed something of a legend in the business and a mainstay at Davos, I must say. Somebody we welcomed on Bloomberg regularly, and that's Scott Minard, of course. Reflect a little bit about Scott, what he left behind, what he did, how he changed Guggenheim, and even Wall Street more broadly.
So thank you for asking about Scott. It was quite a shock to learn of his passing. Scott and I worked together and were friends for over 20 years. And the industry's lost a tremendous visionary, and I've lost a dear friend. But there are several legacies that he left. The most important to me, of course, is the investment process that he helped craft and develop at Guggenheim. And it's a team-based approach based on behavioral finance. We have a deep bench of investment professionals. We have about 1,000 employees and nearly $300 billion of assets under management. You know, I've been at the firm for almost 16 years, and together we've built that investment process. I've stewarded and shepherded the investment process and the team members along with Scott for all these years. That's going to be an incredible legacy that we're going to continue, and we're going to continue to deliver the client excellence and service that our clients have come to expect, and we'll remember Scott forever.
Well, Scott obviously left a very large footprint behind him on Wall Street, on Bloomberg, certainly on Guggenheim. He also had a real presence at Davos. He had interests that went beyond what we would think of typically as Wall Street interests, global interests that are taken up at Davos. Talk about what he did at Davos and what is left behind of what he worked on here.
Well, he had a personal, as well as Guggenheim has a continuing, ongoing commitment to sustainability. He believed in it, we believe in it, and we think the future is one where we have to do all collectively to create value and preserve all of the aspects of nature. And he was particularly interested in the Arctic and the preservation of the Arctic, as well as understanding how climate affected the Arctic. So we ourselves, through our infrastructure team, have continued that work, and will continue the work that Scott started.
Well, we'll miss him, none more than you, I'm sure. And thank you so much. It's Ann Walsh. She's the Chief Investment Officer of Guggenheim. And back to you now, Matt, or Anna.
Thanks very much, David. Wall Street Week anchor David Weston there with Ann Walsh in Davos, thinking about the investment strategy, but also reflecting on Scott Minard. Now, coming up on the program, more from Davos with the CEO of stablecoin issuer Circle. Lots to talk about when it comes to the crypto space. Jeremy Allaire joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former New York Fed President Bill Dudley. That's at 7:30 a.m. New York time, 12:30 p.m. in London. This is Bloomberg.
I would separate crypto from digital assets broadly. And I think there's still a bright future for tokenization. There's a lot of central banks thinking about central bank digital currencies. So I think that's proceeding forward at pace. And I think in terms of crypto as a broad-based investment asset, I think we're going to have, I think it'll be a while before we see that.
The CEO of State Street, Ronald O'Hanley, talking crypto in Davos. We'll continue that conversation right now with Bloomberg's Lisa Abramowitz. She is sitting down with the CEO of stablecoin issuer Circle, Jeremy Allaire. Lisa?
Thank you so much, Matt. Yeah, it's really a fascinating conversation at a time where people are talking about a crypto winter around the world, and yet here at Davos, there's a lot of optimism around the potential for crypto assets, for the whole blockchain technology. We are here with Jeremy Allaire, the CEO and co-founder of Circle Financial, and I want to start there. I mean, at a time when you have bankruptcies, when you have allegations of fraud, are you surprised by the presence of crypto and the optimism of it here?
I'm not really surprised. I think a lot of people have asked me sort of why is there that kind of confluence here, and I think part of it is that, you know, blockchain technology and cryptographic money and all of these digital assets, they sort of sit at the intersection of new constructs in economic activity. And the World Economic Forum is a kind of natural place where people interested in that can convene. And so bringing people here on that basis makes sense. But in terms of the optimism, I mean, look, I've been through multiple major tech boom and bust cycles, and I'm a technologist by background. And when I look at what's happening, when I look at the past 12 months of technical innovation, I look at the current environment of technical innovation in this space, it's more robust than ever. There's tremendous progress being made in so many places. And, you know, the technology didn't commit fraud. The technology didn't commit poor risk management or leverage decisions. Firms and people did that. And so I think the optimism is grounded in the fact that we're really progressing these platforms, and we're seeing the mainstream utility phase of this really starting to come upon us.
So understood that perhaps it wasn't the philosophy or the concepts or the software behind this that caused some of the damage, but you are seeing the fallout continue, and we got word this week that Genesis is potentially filing for bankruptcy this week. We're seeing the fallout from FTX continue. How many more bad actors need to get weeded out? What percentage of the overall industry need to kind of see that wash out before you can start to see real growth?
Yeah, you know, I think there's sort of the natural busts that will happen because they're, projects or companies that just don't have access to capital. So sort of like after the dot-com bust, there'll be some of that. But I also think there are still actors in the space that have been reckless, that have done a lot of illegal things, that operate kind of offshore. And I think until there's normalized kind of regulatory treatment and the world understands how this functions in a regulated way, that ultimately makes those kind of actors disappear. That's a challenge. Now that will take a longer period of time. At the same time, though, we're definitely seeing emerge those companies who have been built well, who've been built to a higher set of standards with regulation, with a very different kind of fundamental philosophy. And I think those are going to be the companies that thrive.
Well, do you feel like, though, even here, there are some companies that may not survive, right? I mean, that there basically is still a strong presence of those that don't have as solid models and might not be having the same kind of accounting practices as you would adhere to?
Yeah, I mean, clearly, I don't want to call out specific companies or anything like that.
You could. I mean, no one's listening. Go ahead.
Yeah. No, but I think clearly in any kind of cycle like this, there are going to be, whether they be technology projects or financial intermediaries or others that continue to have challenges or weakness, and that may 24 months from now not really be here. But again, I think the companies that are run to a higher standard of public accountability, transparency, trust, risk management, kind of operating, out in the light, so to speak, will be much stronger.
You talk about regulators and the role there. I know that you've spoken to a lot of people who are thinking about it. It's certainly on the minds of everyone from central bankers to politicians who are here at this event. What have the tenor of those conversations have been? Do you have the sense that they will really do something material that could create the infrastructure for a more viable market?
I think so, and there's kind of like two big buckets, right? I think the lowest hanging fruit that everyone has talked about actually now for years is stablecoins, which is the business that I'm in, and there actually is stablecoin regulation going into effect in the EU, in Singapore, in Japan, in the UK under the new financial markets legislation, and very likely in the United States, and that's really critical because it's kind of the base layer of digital fiat, digital dollars. And having that be regulated under the same regulatory bodies as banks and payment systems will actually make this something that households and firms and other financial institutions will feel like they can depend on. There's the market side of this, which is the trading and markets, and that part I think is a little more complex. But I think from the conversations I'm having, whether it be participants in the Financial Stability Board or individual governments, there is a sense of we have to now be more proactive about coming up with regulation here, because the risks actually are too high, because this will continue to grow. And so if it is becoming part of society, it needs to have same risk, same rules type of approach.
And the stablecoin model is not based on nothing. It is based on having the reserves and keeping it tethered to the dollar or some major currency, and then holding those reserves in very liquid instruments. Right now, you're making a lot of interest on that as you see the rate hikes. I know that you've talked about going public before. You've postponed some of those plans. Have you brought them back to the table? I mean, is that imminent in terms of taking an IPO public?
Well, so I think what we've said is we're committed to building a publicly traded company. We think it's important to have the transparency and the trust that comes along with that. If we're going to, build partnerships with leading financial institutions and corporations, that's an important thing for us. We're in a very good financial position. We're profitable for all of last year. We're in a good, we're in a high growth environment as a company right now. We grew 300% last year, we're kind of taking stock and really trying to look at where the markets are, and certainly we'll pay very close attention to where the markets are.
Just before we finish, I'm curious, the relationship between Bitcoin and stablecoins. Do you think that as stablecoins get more established, there will still be a role for Bitcoin?
Well, my view is like the total addressable market for something like digital dollars is kind of, the total addressable market for cash or even M2 electronic money, so commercial bank money. So that's a $100 trillion addressable market. And I think that market is grounded in people who store value, who have working capital needs, who are making payments. That's a very big market. There's also a market for people who want to hedge against various, geopolitical things, or who want a non-governmental form of store of value. And we have proxies for that in certain asset classes, and I think that will continue to be a big market opportunity. But it's really aimed at and solving a very, very different thing. So in the long run, I believe that dollar digital currency, euro digital currency, reserve currencies that are operated this way will be a far, far larger market than something like Bitcoin.
Jeremy Allaire, thank you so much for being with us of Circle Financial. Back to you, Kailey.
All right, Bloomberg's Lisa Abramowitz in Davos with Jeremy Allaire, the CEO of Circle. Thank you so much. And Matt, so interesting to listen to that conversation there about the relationship between Bitcoin and stablecoins, but also this idea of can stablecoins coexist ultimately if we do see broader central bank digital currencies, and what kind of regulation do you actually need to see take shape here in the U.S. to make that happen? Because we've talked a lot about it, yet Congress still hasn't moved on the stablecoin issue in a material way.
Yeah, absolutely. And that's what we expect them to do first before they tackle any other regulation. I also think it's interesting, though, to hear Jeremy talk about the need to separate, a basic fraud or some crimes committed by individuals or companies from the technology and the underlying, currencies or commodities involved in that those companies are involved in. So, by the way, you can catch our program, Bloomberg Crypto, every Tuesday at 1 p.m. New York time, 6 p.m. London. Definitely tune in. Me and Kailey walk you through everything having to do with the digital currency world.
Essential crypto viewing. Now, after the closing bell today, Netflix will report fourth quarter results. The company's new subscriber count and initiatives to increase revenue will be in focus. For more on what we can expect from Netflix and other big tech companies, Alex Webb at Bloomberg Quick Take joins us now. Alex, good to see you. So, as always, the focus on subscriber count here at Netflix. Is that once again the story?
Yes, absolutely, but also focus on how much of that subscriber count is going to be coming from the new ad-supported tier. They introduced this new tier, which was, on the cheaper end.
You pay less but get ads.
You pay less but get ads. Now, it potentially is a huge opportunity for them because it could reduce the churn, the number of people who are just ditching Netflix because they think it's too expensive. But if they get that ad business right, it could end up generating more revenue per subscriber than even the premium tier. If they're able to generate something like $7 a month in advertising revenue, which is something that Hulu is able to do, its competitor, then actually that brings them to $15 or so or more in average revenue per user. So it's potentially quite promising. It's still early days.
Yeah.
Any color on what they've been able to deliver so far will be, listened to very keenly.
So, Alex, obviously that's a kind of top-line factor, but when we think about the other side, the spending side of the business, we have seen big tech company after big tech company, Amazon, Microsoft, for example, cutting jobs, trying to cut costs in the face of a different economic environment. Where can Netflix realistically cut costs when they've been spending so much on content, and content is king?
Yeah, it's the real challenge that Netflix has, that in order to attract new subscribers and equally retain the ones you have, you've got to be bringing out big-ticket new shows on a fairly regular cadence. That is something where it seems like they've slightly found their groove in doing that. Some of the capex that has been splashed out in the past few years may not be quite as necessary because they have built and set up studios in places like Madrid, outside London and elsewhere. So perhaps some of that capex drops off, but still the greatest expense is making the shows themselves. Any color on what their plans are in that space, whether they think that perhaps there is space to kind of tamp back on that, analysts will be paying great attention to, but they do sort of constantly need to be chasing their own tail.
What did we get from the Glass Onion screening in cinemas first? Was that just a gimmick, or is that part of a model that Netflix wants to develop going forward?
Well, it's to do with the way that you attract and retain talent, because if you want to get a top director making films for Netflix, they want to be eligible for the big awards, Golden Globes, Oscars, all that sort of thing. In order to be eligible for those prizes, you have to have a cinematic release of some sort. So if you can give them even a limited release, it means it gets in front of more eyeballs, it gives them the chance of winning these awards. That also gives some oxygen to Netflix itself. And HBO has this view that actually having a cinematic release and then putting it on the streaming platform makes the platform more attractive because it seems more premium.
Okay, yeah, certainly gets people talking. Alex, thanks very much. Bloomberg Quick Takes Alex Webb with the latest on what to expect from Netflix. Just want to quickly talk about what we're hearing from Francine Lacqua. She's speaking in Davos. She's saying she is determined to bring inflation to 2% in a timely manner. This at the ECB, of course. And this in the context of some fairly hawkish commentary earlier from the Bank de France governor and Klaus Knott at the ECB. So that seems to be continuing to be the focus, that inflation, bringing that inflation down. We see stocks falling a little this morning here in Europe, partly as a result of this, and short-end yields on the rise also. Morgan Stanley CEO James Gorman joins the team in Davos shortly. This is Bloomberg.